Here are the crypto top headlines covered in this video. Bitcoin plunges to $66,000, altcoins tumble 10 to 15% on ugly day for risk assets. Next, BlackRock could open the door to U.S. regulated stablecoins. Also, 90% of Bitcoin ETF inflows are still retail, says VanEck CEO. Welcome to Crypto Top Headlines, where there's no clickbait thumbnails or titles, and no speeches on my opinions, just bringing crypto's news to you. We have a quick request that doesn't cost you anything in order to help. Help us grow this channel to 1,000 subscribers by September, which would be our channel's 1-year anniversary. All we ask is that you click on the like and subscribe buttons, as well as the notification bell. By clicking on these, it does help grow the channel, so thank you in advance for doing so. Now, on to these headlines. Our first top headline: Bitcoin plunges to $66,000, altcoins tumble 10 to 15% on ugly day for risk assets. Looking beyond today's decline, investors may expect continued market weakness due to the tax season, Rise Labs said in a report. Cryptocurrencies tumbled Friday as risk-off sentiment in traditional markets amid flared-up geopolitical risks spread over the digital assets. In fast downward afternoon action during U.S. trading, Bitcoin plunged below $66,000 after having challenged the $71,000 level just hours earlier. At press time, Bitcoin had bounced back to $66,700, down more than 5% over the past 24 hours. Ether, or ETH, the second largest cryptocurrency by market cap, fell as much as 12% to $3,100 before a modest bounce cut the decline to 8%. Smaller cryptos suffered even heavier losses in the panicky action. The broad market CoinDesk 20 Index, or CD20, dropped nearly 10% with Cardano's ADA, Avalanche's AVAX, Bitcoin Cash, or BCH, Filecoin, or FIL, and Aptos, or APT, plummeting 15 to 20%. The drawdown triggered the largest leverage washout in a month, liquidating some $850 million of leveraged derivatives trading positions across all digital assets, CoinGlass data shows. Some $770 million of those positions were longs, betting on rising prices, caught off guard by the sudden decline. The dip occurred as stock markets sank during the U.S. trading session amid rising fears of broadening conflict in the Middle East, as U.S. authorities warned that Iran could prepare to launch a significant attack on Israel. Treasury bonds and the U.S. dollar index, or DXY, surged as traders flocked to hedges, while key U.S. equity indices, the S&P 500 and NASDAQ 100, slipped 1.7%, an hour ahead of the close of the trading session. Gold, long considered as a haven asset, surged past $2,400 to a new all-time high before paring its gains, while oil ticked 1% higher. Digital asset investment firm Rise Labs, formerly Sino Global Capital, said in a Friday commentary to anticipate some short-term market softness for crypto assets due to the upcoming tax season. However, it maintained a more constructive long-term outlook, expecting relief for the asset class as policymakers will slow quantitative tightening and potentially adjust monetary policy to facilitate U.S. government debt rollovers. Let me pause here for a moment. If you're getting value out of this video, please click on the like and subscribe buttons as well as the notification bell. Our next top headline: BlackRock could open the door to U.S. regulated stablecoins. The increasing engagement of Wall Street firms in the stablecoin market may accelerate regulatory advancements and pave the way for a private counterpart to the digital dollar. Wall Street firms' escalating involvement in the stablecoin market could speed up the development of regulations in the United States, creating a private alternative to a central bank digital currency, or CBDC. According to crypto investor Ryan Sean Adams' analysis, the recent launch of off-ramps in USD coin, or USDC, for BlackRock's tokenized fund is just another step in the ongoing integration of traditional finance and stablecoin providers. Stablecoins will happen in the U.S. because BlackRock and the banks want them to happen. This could not be more obvious, Adams said on X. Circle, the issuer of the USDC stablecoin, announced on April 11th the launch of functionality that enables holders of BlackRock's USD Institutional Digital Liquidity Fund, or BUIDL, to transfer their shares to Circle in exchange for USDC. In other words, the functionality allows investors in the tokenized fund to convert their shares into stablecoins 24 hours a day, thus enhancing shareholder liquidity. BlackRock is a major investor in Circle. In April 2022, the companies announced a strategic partnership that included BlackRock investing in Circle's $400 million funding round. BlackRock also manages the Circle Reserve Fund, a government money market fund in which Circle is the only eligible investor. The new BlackRock BUIDL fund on Ethereum is a high-bandwidth pipeline between U.S. Treasuries and USDC, Adams noted, adding that Circle's planned initial public offering will also help stablecoins integrate with traditional markets. The banks will backdoor themselves into stablecoins by acquiring, partnering, controlling crypto-native companies, and they'll lobby for stablecoin legislation and make it happen along the way. The U.S. does not have the political will to build a central bank digital currency. They create one de facto through private bank-issued stablecoins on public crypto networks like Ethereum. BlackRock is already one of the biggest players in the crypto industry. The asset manager is behind the iShares Bitcoin Trust Spot Bitcoin ETF, worth $18.5 billion as of April 10th. The company recently launched its tokenized fund, BUIDL, enabling investors to buy tokens that represent shares in a fund investing in assets like U.S. Treasury bills. Our next top headline, 90% of Bitcoin ETF inflows are still retail, says VanEck CEO. The CEO of investment management firm VanEck says spot Bitcoin ETFs have mainly attracted capital inflows from retail investors in the 4 months since their launch. Bitcoin exchange-traded funds, or ETFs, have attracted significant amounts of capital in 2024, but traditional banks and institutional investment have yet to enter the fray. Speaking exclusively to Cointelegraph at Paris Blockchain Week, VanEck CEO Jan VanEck said the retail sector has primarily been responsible for inflows into spot Bitcoin ETFs in the United States. VanEck said that the initial success of the ETFs, which have on some days seen billions of dollars of inflows since their launch, surpassed his expectations. However, he believes the inflows have not come from significant investments from traditional finance, or TradFi, players. I was surprised, but I don't think it's traditional investors yet. I still think 90% of the flows are retail. You've had some Bitcoin whales and some other institutions move some assets in, but they were already exposed to Bitcoin, VanEck said. The CEO of the investment management firm added that no banks have officially approved or allowed their financial advisors to recommend Bitcoin to date. VanEck said that the next month could see the arrival of some major institutional investments from banks and traditional firms, but that the Bitcoin ETF landscape was still in its infancy. There's a lot of maturation to happen. A lot of technology will be developed on-chain, so there's a long way to go. Cointelegraph also asked why investors would prefer to invest in a Bitcoin ETF over directly buying and managing ETF themselves. VanEck said convenience was a major reason, as investors looked to fund managers to handle their entire portfolios. Convenience, safety, and affordability. You had 2% spreads on many centralized exchange platforms like Coinbase. You have single-digit spreads for the ETFs and no fees or low fees. It's easier just to do a buy ticket than anything else, VanEck said. Following in his father's footsteps, VanEck was founded in 1955 by John VanEck, who would make his name by starting the first gold fund in the United States in 1968 when gold was fixed against the dollar. VanEck said his father's fund boomed as inflation soared in the 1970s. VanEck said that his tendency to be a paranoid business person has kept him alert to any emerging assets that could contend with gold. In 2017, we said Bitcoin will not replace gold, but it will significantly complement it in people's portfolios. VanEck said his firm's big picture approach to investing is driven by the understanding that political, economic, and technological trends will drive financial markets. Up until the 2010s, there had not been an emerging asset until Bitcoin rose to prominence. I started looking at Bitcoin. I'm not like super in love with it or anything. I just think at times you really want to have a store of value in your portfolio. And that's what I care about, people's investment savings, VanEck explained. The CEO added that there's an argument for Bitcoin being a better store of value than gold in contemporary times. He also said that the U.S. has big budget deficit problems that it must tackle in the coming year, and that market movements are reflecting anticipation of this reality. While much has been made of the impact of Bitcoin ETFs and the price appreciation of the preeminent cryptocurrency in 2024, VanEck said their impact might be overstated. What I'd like to point out is that it's not the most earth-shattering thing. The Bitcoin market is more global and much deeper than just being influenced by the ETFs. VanEck pointed to a sharp rise in price in early April that did not occur during U.S. trading hours, which is indicative of the influence of Asian markets. So this concludes Crypto Top Headlines. If you haven't already done so, don't forget to click on the like and subscribe buttons as well as the notification bell. Also, leave your thoughts in the comments and share this video with your friends and family. Thank you all for watching Crypto Top Headlines, bringing crypto's news to you.